start recording.
Okay.
All right, cool. Oh, I got some, hey, Renee from Tennessee, Christina from Southeast Florida. Good to see you. Hey, Judy from Knoxville. Great little area. Hey, Belinda. A lot of our Strive members are on, and I know we have a lot more people joining us. So I'm going to jump in. We like to start on time. We like to end on time. We're really respectful of everyone's time. So Amy and Stephanie, thank you so much for being on. These two amazing women are from PPR, and they're going to be talking about equity and debt, especially as we are navigating passively investing in different opportunities and what might be some advantages of either. I am both I have equity. I'm passively invested in equity and debt, so to speak. And right now, the debt side is getting a lot of attention for a lot of different reasons, which I know you guys will go into because we're in the business, right? But we're going to get into those type of and really try to demystify it and simplify it, right? So people feel comfortable and are braced with the knowledge that you need. Before I do that, I really want to jump into just a quick chat because our goal here is that this is a live session, right? This is not pre-recorded, and obviously, we want to make sure everyone's kind of engaged. So I want to put in here in the chat, and I just had it up on my screen. Let's give me a moment. And then it, of course, went away. So give me 1 second here. Okay. I want to put a question here a little bit about, is it better to, the question is, so I'm going to put it in the chat, but I also just want you to answer in the chat box. Is it better to, here, I'm just put it in here, and then I'll just tell everyone what the question is. And I love this question, Stephanie, that you sent. So in the chat, please share your thoughts. Is it better to invest in debt or equity investments? And you can't put, it depends. I want you to think about yourself because that is why you're here. You're looking to grow your investments. You're looking to grow your wealth. That's what Investor is all about, right? Helping you build your wealth and pass along wealth to other generations. That's why we do what we do. So the question is, what's better for you right now? What are you thinking? Where's your head at, especially if you're looking for passive opportunities? And so many women, right, Stephanie and Amy, are frustrated with the deal selection out there. And they are looking, can I put my money at least in a year somewhere or 2 years? At least I could keep making money with it versus it waiting, right? And I know so many women are kind of have money parked and it's not doing anything except maybe making some,
not serving them,
some sad percent in a savings account.
Right.
Okay. So I'm going to read some of these, just sad amount. I know that is it, but okay. So my mission, okay. Equity. Okay. Christina, right? Right now I'm looking for cash flow. So I need to invest in debt investments. It's a very good point. I'm sure you guys will get into that. It's a really good point. Yes. If I'm that passive investor, I'd prefer debt. Yeah, it is about your goals, right? I would imagine. And that you guys are going to get into is what are my goals and what vehicle will help me get there. Right. So without further ado, I'm going to pass the baton to the two of you. And then what we'll do is let you, and I want everyone on the call to be thinking of any questions you want to ask, but put those in the Q&A box for me so I can manage the Q&A box. And then about 30 minutes, I'm going to start asking some of those questions. And I also have some questions that have been submitted. So everyone feels like they're getting the knowledge that they need. So they've better information to make decisions as they navigate this. So thank you so much for being here. These two lovely women and their team will be at InvestorCon as well, coming up in June. They're going to be doing Amy's going to be doing a breakout, right? Yes. Really excited about that. You guys have been amazing supporters of our community. Such a solid company. So thank you for being here.
Thank you for having us. Yeah. We feel vice versa with Investor. So it's a good collaborative union here.
Yeah, absolutely. All right. And I'm going to stop talking and give you guys the floor. Give you ladies the floor. Excuse me.
Perfect. Well, if you just want to introduce Liz, I don't know if you want us to share our screen. We can certainly just talk to what we want to. Yeah.
Yep. Go for it. Yep. Jump in. That'd be great.
Okay. Perfect.
Make sure if you can do that. Let me know if you need any help.
No problem.
Okay.
So we'll just show you, we'll flip through our slides here quickly since, we don't have our whole setup, but just wanted to introduce Amy. I don't know if you want to speak to your background.
I mean, basically the first two slides is one about me, one about Stephanie. It's kind of our background, what we do at the company.
Hey ladies, sorry to interrupt you, but could you put it on presenter mode? Because we see all the slides on the left and then we see the slide in the middle, but is there a way to do the, what is it called?
Yeah, to make it large. I think the issue was there we go. Well, that should be better, right? You can see that.
Perfect.
Okay. So first I'll introduce myself for those who well, none of you probably know me. My name's Amy Staven. I am the Director of New Business Development at PPR Capital, which is a new role for me within the company. I've been in the company for 6 years. Prior to this role, I was the Director of REO, Asset Management. So it was kind of a great transition for me. I have been on the other side of this company as far as doing valuations, looking at tapes, looking at deals that we're interested in possibly buying, and then also looking at how is our best exit, how we sell. So I've bought and sold, well over $1 billion worth of real estate. So I had great experience doing that even prior to PPR. And with PPR growing and evolving, they brought me over to the investor relations side, primarily because we wanted to have a voice in the women investing community. Stefani and I are tasked with bringing in women investors and having women, more active and more involved in passive investing and investing in real estate. As we all know, it tends to be, and the tide is changing, but traditionally, and especially in my age bracket, when I started in this kind of space about 25 years ago, I was almost always the only woman in the room. So, this is where we're trying to move forward as women investors and be informed and, be kind of the captains of our own ship and make our decisions. So that's basically who I am and what I do for PPR.
Perfect. Yeah, and briefly, I'm in my 3rd year with PPR. I have 10 years in experience in financial services. So I've worked on the other side of the world, outside of private equity, traditional stocks, bonds, mutual funds. So made the jump here a couple years ago as a way to grow my own career and my own experience. So I work directly with investors, raise capital, and with Amy, provide education, about what we do and the equity private equity world. So we will hop right into our presentation here. So first, we wanted to kind of present the question of, we know passive and we know active. Which is right for you? Is it a mix of both? And just, Amy can take it away from here.
Okay, so I think the first place we're going to start is what is passive versus active. All right. And I mean, and I'm maybe oversimplifying, and I know your audience is, probably a wide range of experience and knowledge in real estate investing. So passive means you are allowing an operator or someone else, you're giving them money and they are controlling your investment, right? They're the boots on the ground. They're doing the diligence, they're getting whatever needs to happen for your investment to, maintain itself, to add value to it. You are just getting a return. So you're putting in money for an investment. You are doing nothing. You are getting actually a fixed return, for whatever, say you are investing $100,000 into this passive real estate investment fund, that in 3 years' time, you're getting a 12% return. It has a beginning, it has an end, and really, you can look at your investment on your portal, but you don't have to do the work. Active, fully different. You're fully involved and immersed in your real estate investment. So you're looking at the property, you're doing your own diligence, you are doing your own boots on the ground, you are going to that property, you are looking at it, you are trying to buy it at the right price, because then you're going to you're going to add value to it, you're going to renovate it, you're going to rent it out, whatever your exit strategy is. You are actively involved in doing, you're paying the real estate taxes, you're paying for maintenance, you're paying, you're the operator. So that is, it's different strokes for different folks. I used to be an active investor. I was a huge fix and flipper. Now at this stage I am in my life, I'm a completely passive investor. I don't have any active real estate investments. And that's more, I'm a grandmother. My kids are fully grown and out of the house. I, have a full-time job that takes, exactly the amount of time I want to give to my work environment. And I'm on to the next phase of my life where
Right.
I'm going to have more time. Active, when I was in my late 20s, 30s, even early 40s, I bought and sold and fixed and flipped and was fully immersed, worked 7 days a week. Yes, oftentimes had a bigger return for the money in and out because I was doing all the work, right? But there was also a bigger risk because it was all my money. And if it didn't go well, I was holding the bag at the end, right? So that's the difference.
Yep, and I think that is a good segue into what we want to talk about next, which is, assessing your risk tolerance before we're going to do either passive or active investing. Where are we? What point in our life are we at? What are our goals? So the biggest one, that's what we talk about with investors quite often, is where are you on your age timeline? Are you actively working? Are you still growing, your investment accounts? Are you looking forward to the future? Are you nearing retirement where now we need to curb back, our risk a little bit? We need to claw back some of the things that we were a little overexposed in. And then of course, in retirement, that's where we flip into our, more conservative type of investments. So passive versus active being obviously something we're going to do earlier in life. How do you feel about volatility? I mean, we see it obviously in the stock market all the time. Things are, widely affected by a range of things. Real estate, probably not as volatile. You don't see the
Well, it can
daily.
be.
It can be. That's true. That's true. So yeah, what's your volatility? How sensitive are you, to something? You need to be in a safer investment if, you're gonna panic. I mean, because it's at the end of the day, we need to be comfortable, I think, in what we're investing in and feeling safe in what we're doing and that we can sleep at night. So knowing, what kind of volatility you can withstand is important. Your net worth in general plays into how, what you can invest in. I mean, are you an accredited investor yet? Which opens different doors, than non-accredited investors, but do you have a goal to be there? What's your timeline? That way, you're adjusting your risk as you move closer to accreditation status. And then, similar to bring it back to, our first question there, are you investing for today or tomorrow? Are we planning, legacy planning? Are we planning for the future? Are we, getting our kids' college accounts set up? Are we getting ourselves out of working and into, a passive income situation where we want to, maybe middle age and we want to do active, but not have to work our W-2 job? So those are all the questions. And I think Amy and I are always saying it's important to be honest with yourself here and not say, oh, I think I can, handle this type of volatility or and then truly, you can't, and then you're uncomfortable in your investment and you feel, not great about making it. So just a little self-awareness, self-reflection before we even dive into, investing. So now we'll talk about private equity in general. There are so many different avenues you can take. Again, we're real estate focused, we're real estate people. So, we live in this world. But there's debt and equity and they fit different risk profiles. So just the kind of general overview of your typical equity investment. It's like, with my background, most similar to a stock. So you're going to put in X amount of dollars and you get some sort of ownership in, whatever this investment or fund or company might be. A little bit riskier than just, your general, kind of passive investing. However, with, risk, there's typically higher returns that come with equity investment. However, subject to a little bit more volatility. There's a little more uncertainty. You're investing, in maybe a bunch of different aspects, lots of different things the company invests in. So there tends to be a little more, volatility in an equity investment. However, could be lower fees, could be, there are definitely, advantages, disadvantages to both. But this one, you're getting the ownership stake and your return is essentially, like a performance-based return. So we just had a little, example of that here. Like Amy was mentioning before, your equity investment, you're going in with an operator, they're doing the buying, the selling, they're doing the, the day-to-day. And then your return is typically, based on their profit. So when they're doing well and everything's performing according to plan, you're getting that higher return. However, when, the market is a little volatile, when things start going wrong, or management just in general, maybe the operator, wasn't doing what they said they would, you're typically going to see your return suffer as a part of that. You know, duration can vary, could be very short term, some are, you know, a little bit longer. But again, part of knowing your risk level is knowing how long you know, in either investment, knowing how long you can part with, you know, a chunk of your money, whether that be, you know, a $50,000 investment, whatever it is. If something were to change tomorrow, you know, do you need that money back? Are you locked in? You know, so that kind of, just wanted to give the example there of that. And then we have the other side of the coin, our less risky, you know, our debt investments. So
Do you want me to speak to
Sure,
that?
Amy can speak to this one.
Okay, so a debt investment. You're a lender, you're investing in loans. So typically, if you're investing in debt, you are have a fixed rate of return. You have monthly payments, your fees may be higher. It's a shorter term investment, and the investments are asset backed. So and we'll get into this within this presentation. I first I want to say, I think it's smart to be invested in both debt and equity. I think it actually changes roles as, you know, for a lot of people, when you're younger, you may have more equity investments.
Yes.
And as you get older and you're looking for a more fixed, very solid kind of return, you're going to look more to debt investment just because it's more black and white, right? When you're investing in debt, you have a beginning, a middle, and an end, and they're pretty transparent. You know what your return's going to be. So
Right, you're capped in a debt investment versus
Yes.
equity where you might have a higher return, but you're also, you know, not typically seeing that floor in a debt investment.
and you're not
either.
seeing a hard end. It's not as black and white.
Exactly,
So-
right. So a couple differences, and then we just have a, you know, very quick, you know, example, as Amy, you know, had just said. You know, you're the lender when it comes to, you know, being investing in debt. You know, shorter hold time, you're the lender, you get that fixed rate. You know, you're typically capped on what you can earn, but it's, you know, once that loan is paid off, then you're exiting the deal. You know, that's it. Like, it's a one and done type of deal. There's an end to it.
Right. It's
Cut and dry.
simpler. Yeah.
So, and then again, we just wanted to show you the kind of, you know, differences here. So like for a company like PPR, for example, we invest a lot in non-performing loans. So that puts us, you know, first lien non-performing loan, that's your senior debt, you know, lowest kind of risk, first lien, you know, position, you know, pretty low risk, going all the way up through, you know, your bridge type loans, you know, preferred equity, where you're in equity, but you might be in a higher, you know, class, maybe class A, class B, you get your returns maybe before some others. If, you know, things maybe are going wrong, you know, you're still, there are certain assumed, you know, returns that you're getting versus your straight, just common equity, general share class. You have, you know, the same amount of rights or no rights to your return. So just wanted to put a visual to, you know, how that debt versus equity investing looks on a term of, you know, your risk level, risk spectrum, I should say. So again, just to compare, you know, the two and what you're looking for and why it's sometimes best to have a mix of both. Equity, you might see some upside potential. Typically a longer term investment, most people are looking to hold longer in their equity. Higher risk, lower fees. But again, really the upside potential is what you're looking for with equity.
Right.
Versus debt, where you're not going to see any of that, you know, type of profit sharing or upside. It's a straightforward, you know, 10% return for X amount of years, lower risk. Sometimes there's higher fees involved with that. But again, you know, when you're in the middle of the risk spectrum, maybe you're, you know, having a couple of investments that are paying you that straightforward, stated interest rate versus your equity, where you might have to wait till the end. Maybe there's a sale or something coming. So that's your more speculative investment. So we want to go to our next topic. We kind of wanted to talk a little bit about, you know, your due diligence on either side of investing, whether that be in a debt fund and an equity fund, and all the stuff that comes along with due diligence in private equity, because there's a lot more to do than my former world, where you can Google anything about Apple before you invest and find out everything you need to know. Where, you know, private equity, you have to do a lot more of your own digging.
Yeah,
so
you do.
let Amy take it away on this one.
Okay, so if really for debt and for equity, I mean, whenever you're going to part with your hard-earned money or your savings, or you're wanting to see a return, the first thing I'm always gonna say, and I say it all the time, is do your homework. You know, get to know your operator. If you're investing in debt and you're going to use an operator, you're going to invest in whatever fund that may be it, you know, obviously I'm going to say PPR, but there's tons of private equity funds that you can invest in. So you're going to want to review. First of all, you may hear about someone, okay, wherever you hear it on the grapevine of the industry we're in. Check out their website. Look at their team members.
LinkedIn.
Yeah,
Look them up on LinkedIn.
Google them.
Google, yeah.
You know, learn about the fund. Use your own network. And most importantly, and I think as I get older, it's easier for me to do this. So it's easy to say, but very hard to do sometimes. Trust your gut. And I say that because my 30-year-old self didn't trust my gut nearly as much as my almost 60-year-old self does, because I've learned through time to trust myself, right? You are your biggest asset, always. Value your knowledge and you trust your instincts. I think women tend to struggle with this more so than our male counterparts.
Yeah.
So learn to women have this amazing intuition. I think we're far more intuitive than men. So use it. It's a valuable tool.
I agree. And for those who are still learning to, you know, trust our guts all the time, in the private equity space, there are a lot of resources out there. I mean, obviously the InvestHer community is a huge one. I mean, you know, everyone knows each other. You have a place to go where you can ask each other questions, you know, regularly. But there are other websites out there. There's, you know, where you can go meet with investors in these funds. One that comes to mind is Invest Clearly. That's, you know, a good resource. You know, Bigger Pockets is another community. Passive Pockets, where you're reading real time other investors' insights. They're actively in the funds. That way you can kind of verify what it says on the company's website versus how it's playing out for the investors with the team. And, you know, we talk with investors all the time, but, you know, have the second phone call if you feel like you want to, you know, ask the questions, read the PPMs. I mean, there's lots of little clauses and things that, you know, might not make sense. And, you know, don't ever feel like not asking the question, you know, ask the question. It's never a bad thing. And that's what all of us are here for at these, you know, at these funds. We're here to make sure that you feel comfortable. And, you know, again, there's ongoing, of course, things that you should do. So once you've decided that, you know, that you'd like to make an investment, you have to be your biggest advocate for making sure that it's going according to plan. Are you getting financials from these companies quarterly, annually, whatever, you know, they stated they were going to report to you? Are you getting your tax forms? K1s are not always timely as we know, unfortunately, but are you getting, you know, your tax forms? Are they prepared correctly? You know, did I get the most from, you know, a tax advantage standpoint? Did I go into the right type of fund? Did I need depreciation? You know, is the operator following through, or are the properties performing? I mean, these are all things that you should be looking for, because a company should be transparent and updating you on their progress. Because if you're not, you know, and you feel like you're in the dark, it's again another time where it's okay for you to ask questions and, you know, make sure you're protecting your investment. So certainly, you know, most companies have investor portals and they have statements. Just, you know, keep an eye on it. Make sure it's going, you know, according to plan. Of course, every company can run into bumps in the road, but are you getting what you need as an investor? Does, you know, all those pieces of paper, do they have the numbers that need to be there for you?
Yeah, you do your own surveillance.
Absolutely. So, you know, we have actually, you know, other things we can talk about. We have a, you know, little case study at the end, but we also wanted to, you know, of course, leave time as we hit the 30-minute mark here for the questions and answers.
Great. Yep. Please, do you have an example of one of the two, whether it's debt or equity? I think that would be great for everyone, especially on the debt side would be my thought process. But yeah.
Go through a note. You want to?
Yeah, just go to the next slide and I can
put in the chat box. Put in the chat box. Yes, if you'd like to see an example. So I know everyone's still with me here.
I'm going to talk you through an example. Okay. So, and this is a deal that obviously PPR did, right? These are, you know, HECM, which is reverse mortgages, their first lien positions, the borrower's deceased. It's definitely debt. So first things first, it's your purchase price, okay? So PPR purchased this first lien for $142,000. This is not a situation where the borrower is living because it's a reverse mortgage, the borrower is deceased. So we knew going into this that we were going to get out, we were going to have to foreclose because that's the way you clear title on these kind of accounts. Took it through the foreclosure process. We take it to sheriff's sale. Now at sheriff's sale, you can only by law set the bid at full UPB, which is unpaid balance on this note. So at this rate, if our purchase price was 142, by the time we take it through the whole foreclosure process and we're adding principal, interest, attorneys, time, I believe our UPB was about 180 on this one. So I can, and here's an example, Little Falls, New Jersey. It was listed in the paper, right? This was in a sheriff's sale. No one bid our minimum bid, which was our full UPB. So occasionally, like for this one, we got lucky. We sometimes, you know, when we know the market's strong and we know that we're going to get way more than we purchased it for, even adding on everything, we are happy that it comes back to us because we could only max out at sheriff's sale the UPB. Once it comes back to us, we can put it on the MLS, and whatever we can get for it, there is no maximum amount of a return. So here you go. We sold it for $314,900. We had 15 offers. It was 106.38% of the list price. This is debt. All right. This is investing in debt right here, and how the return can be spectacular, especially when you're doing it passively. This was something PPR did. We did this start to finish. All you did was invest your, you know, and you're at a fixed rate or whatever. So you're getting the return guaranteed. This is how we make our money. This is how we pay our investors. These are the deals we do.
Amy, I think it'd be really helpful because I know how funds work from the perspective of it's a pool of money from what? Accredited and non-accredited, or only accredited? Let's start
accredited.
Only accredited. So an accredited investor, what's the minimum?
50. Well, it's 25,000 for a 6 month, but it's 50,000 for a year and 50,000 for a 3 year. And it's a 12%, 10% and 6% return. And if you compound, it's 14.
Yeah, you can vary how you get your payment.
You can do a month interest or whatever. So there's different ways in which you can invest in debt. And you know, you're going to just get your targeted return. But as an individual, put it this way, if you are an active investor, right, you want to be not passive, you can look to buy a first lien reverse mortgage note. And here's a way in which you can see where the returns can be if you do your homework, you do your diligence.
Sure. But the bigger picture is that the fund, so folks could put 25K, 50K. How much money is in that particular fund that went and did this particular deal? Like, what does that fund look like in terms of, is it
70% of our equity in those funds is from non-performing first liens. Yep. So
okay, so you look, so that's that's kind of like the asset class. And I kind of want to make a point here that funds are investing in different asset classes, different strategies, and it typically aligns with what's happening in the market. That's why you see a lot of, because interest rates are higher, people are like, okay, where can I get money that may be either at that or quicker? So you'll see funds that are coming together in the sense that they're now lending it to that end flipper or that end person doing new construction. That's very, you know, you're seeing that often right now. So it depends on what's happening in the market. I think that's the big picture, right? That you want to be mindful of whether you're investing in debt or equity, because debt's gotten more, I don't want to say popular, but I'm sure there's debt. I feel like it's gotten more popular in recent years.
100% has. Okay. I agree with you.
And why would you say that, Amy? Because I think that's really helpful for everyone to understand why.
Okay, because the market we're in right now to get deals in equity, just with the huge escalation in values in the market,
Right.
it's hard to even get a deal to the table, right? There's
Sure.
so much competition. So for a lot of people right now wanting to invest, it's just debt is an easier way. There's way more availability of different asset classes and different ways to invest in debt. As far as equity, equity, you're building something. You're putting in money to create something better. And in the market we're in, it is challenging to be able to buy those kind of equity investments at a price that makes sense, where you actually are going to have equity, because you're paying
Right.
so much. It's hard to have equity right now because you're not getting a
That's
deal. The goal is, when you buy something, whether and you want to make it better and you want to invest in it and have it, you're going to add value, right? Well, you have to buy it where adding value makes financial sense for a return. And in this market, it is very challenging.
and it really then depends on your particular goals, because so many people, and I don't know if this is for many of you on the call, but some of you are looking for the tax advantages, right? You want to have a piece of real estate, so you're an LP, and that equity play is actually more part of your tax strategy. Other
Right.
people are like, I have so many different properties, I have that covered, I want a fixed rate, and that's where the debt, i.e. lending, comes in. And so many people talk about private lending. A debt fund is pretty much taking a bunch of people's money to
Right.
lend to individuals or different deals. That's a really, people think
Bingo.
private lend.
That's-
Yeah, I just want to be
Hit
very
the nail
clear.
on the head.
It's just a way to pull that money together for a
Right.
professional company like a PPR, and a company that has those relationships, right? They're able to then go and do these types of projects at such a volume, right? Non-performing, performing, that they can then, they're hedging the money that they're making so that they can pay the 10% to 12%. It all makes sense because they have millions of dollars at play, right? So that's just, again, if that helps anyone, I think we get overwhelmed with these things, and it really is very simplified when you start to think about it in the sense of lending versus like equity and ownership.
100%. And you're right. It can be so simply stated, but it can get tangled up in a lot of, verbiage and everything else, and seem complicated, but it really is not. They're two very easy concepts to navigate.
Yeah. I want to encourage anyone that has any questions, and I have a few other questions. Is there another example to share? I think that would be great.
Yeah.
Like one more, and then I can post some questions here.
Let's see. You want to do another?
And let me ask a question while you're doing that too. Hey, Jennifer. Jennifer's one of our Strive members. So she's asking, is it possible to have your 25,000 or 50K investments spread out across multiple different loans? It's a very good question.
Yeah, so that's actually how, particularly our fund works. So your investment is spread across all the assets that are in the fund. So you get all 70% of the notes, you get, the 30% of the multifamily. So your investment does not go into any one bucket of deals. It's spread across the entire portfolio as an investor.
How does it differ from a REIT? Because now that's popping in my head. How does like a core, like a debt fund, and then there's probably so many differences. It's actually REITs more on an ownership level, right?
Exactly.
Okay.
Yeah, it's tax, I believe tax structure is part of it. Often these kind of funds are, your K ones where you're getting an actual dividend from those versus a passive income. So I think it more comes down to structured, and sometimes, you have your publicly traded REITs versus your
Correct
REITs, which are still not, those are not private equity. But it's more, of a tax structure.
Sorry to interrupt you.
Stuff.
Okay. Do you want me to go through? This is an example of a first lien, but retail, meaning this was not a HECM. This wasn't a reverse mortgage gone bad. This was just a note that a first lien that we couldn't get reperforming. So there was our purchase price was $458. We could not get the borrower back on track to reperform. So our ultimate goal when we buy non-performing loans, which this was, is to get the borrower to perform. And then we're going to sell the note back as a performing loan. You buy it as non-performing at 68 cents on the dollar, and you sell it back as a performing at 95 cents on the dollar. That's the secret sauce there. When you can't do it, you're going to take it through a closure and you're going to sell that note, which was first position retail. We purchased it, $458. Our total UPB was $570. See how this says third party sale? Here's an example where this home, if we could have sold it at market value, would have been a much better return. But the most you can go for is your full unpaid balance, your UPB. So this sold at sheriff's sale for $570,000. So we got paid back, obviously, what we bought it for, our interest, our principal, our insurance, our attorney fees, everything else. But that's by law the max you can get back. And that's something for your investors to know. When you buy, or if you hold someone's note and you're like, oh, I'm holding their note and they can't pay me back, they're not performing, whatever, I'm going to foreclose. But they've been in that house for a long time and their unpaid balance isn't that high. You, by law, have to take it to a sheriff's sale. And by law, you can only regain your UPB, your unpaid balance. So these are things to do your homework to make sure that the UPB makes sense, that, you know, you're going to be able to make enough money on the return to make it make sense.
Yep. Good point.
Those are great. I also have a question around for debt and equity. What asset classes are you as PPR invested in, and what can that, what information can that provide everybody on the call? Meaning, not every asset class is created equal. We've heard time and time again, and this is quite honestly a number of women in our community have invested with various syndicators who bought multifamily properties to redevelop them or to reposition them.
Right.
And those buildings are getting literally given back to the bank. And that's not one person's story. That's multiple women's story, right? So there's some apprehension, right? And that's one type of passive, right? You're passively investing, mostly equity, and the asset class is multifamily. So I'm curious to get inside, because this is also just being a savvy investor. Where are your focuses from an asset class, from a geography perspective? This is in Scottsdale. The other one was New Jersey. So just curious to get a sense.
Our buy box, so to speak.
Your buy box, because your buy box then makes me looking at, okay, I can passively invest with these folks. And it's also great learned information of like, this is how, a $1 billion company that's doing, various projects and funds are thinking about their investing. That matters right now.
100% agree with you. Okay, well, our asset class, like, all right, for multifamily, we're like C class. We're buying distressed multi. We're not buying class A. And I don't know, do we have any class B? Not, we have one ground up development.
Yeah,
but for the most part, as far as as far as our single family, our non-performing loans, that's nationwide, every 50 state. And that's also distressed. Obviously, they're non-performing loans. So they have deferred maintenance and they're, not newly renovated, beautiful homes. But I will tell you, PPR, as any investor should do when they are looking to invest in multifamily, single family, we have a very specific buy box of like where we're going to buy multifamily right now. I can tell you, we have recently, we're Tennessee,
Kansas City,
yep. Ohio, Austin, and right outside Atlanta. Like we have done our homework. Well, our team. It's not our homework. It's our analysts and economists and the team.
It's a team. I know.
So it's certainly not, that's a whole different animal than single family, multifamily, and good markets for it. So, they're going to do their homework. They're going to look at median incomes. They're going to look at unemployment rates for specific areas. They're going to look at job growth. They're going to look at where the next market, that's why they're in Ohio. There's a huge amount of growth in the job market in Ohio. So there's going to be a very large need for housing in Ohio. So guess what? We're looking at deals in Ohio.
Right.
And as far as, single family homes, we look at the markets there too. We're going to look at the Sun Belt. We're going to look at East Coast right now, West Coast, maybe not so much right now, West
Yeah.
Coast.
I was just
but
going to ask about,
Yeah.
and that's the other question is, the key is that your buy box. And typically sophisticated investors and companies that are doing this and they're doing it well, not only have a buy box on geography, they have a buy box on asset class, and they have a buy box on their strategy, right? Because you could take a single family home and there's a lot of ways to deploy that single family home. So
100%. You want to know.
you're vetting on those three.
Mhm.
Yeah.
Yeah.
So good. So important. So what about, I'd love to jump into operators and really vetting doing the due diligence on operators, because I know you shared this a little bit, but is there any question that is like a must question that if I'm a passive investor, I need to ask this question to that investor relations person? And I want to hear for what. I think those are really key things. Like, what are the questions that I actually want to ask to assess these things that we're like talking about, right? Nothing's foolproof, but it is in the questions we're asking and then getting the answers back that we're going to get a picture of this operator, right? And be able to say, okay, confidently, I should move forward, or I got some reservations.
Yeah, absolutely. Well, I think, for anyone, anyone can start a fund at any time. So there's, how long have you been operating, and where, if it was a short period of time, what were you doing prior to this? What kind of asset class, do you change asset classes often, or, what's your long-term strategy for the fund? Also knowing, kind of, are these funds that you're going into meant to be open long term, or are they kind of shorter term investments? Do they intend to be doing this for 10 to 15 years in a certain asset class versus a very temporary, this one market is hot right now, we're going to have kind of a more of a
Capitalize,
closed,
open and close. Right.
exactly, more of a closed end deal, look for the next. So you want to make sure that they're, and again, this is all the operators, that their expertise matches their asset classes.
Yeah.
And I think obviously we know our team and the collective experience that, comes into why we do know, why we were 100% a note fund, and only, more recently went into multifamily as we acquired, more expertise and connections and things like that. So really it's, knowing the background of your operators, because, anyone that has enough money can go and acquire an asset, but do you have the expertise? Do you have the right surveillance in place too? What kind of, another important question is, what kind of surveillance do you do on
their track record?
Right,
You need
yeah.
to see, how long they've been in business, what's their guarantee, have they ever defaulted on anyone? Have they ever not paid a full redemption? Have they ever
Those are
been,
great questions. Yeah.
look at their audit,
If they have
PPR just ended up getting, last year we ended up with Deloitte and Touche because we wanted to give that confidence to our investors, right? That, okay, when someone's going to look into us and vet us, we found that gave people confidence, because if you're going to pass an audit by Deloitte, that says something, right? We're not a Ponzi scheme. We're not, our books are in order. We've been in business 18 years. You want to look for funds like that. You want to look at their track record. You want to look at their numbers, and you want to also go on your resources, go on Investor, ask your friend, go on Passive, go on Clear, and look and vet, make sure that they have a good reputation. You
Right.
want, I think like it's the Yelp of,
Yeah, kind of.
you want to make sure they have 5 stars. And if they
Right.
don't, you want to read why they don't.
Right.
Yeah.
Absolutely.
That's great. I love to go, but if you can go back, Stephanie, to the screen that had scheduling a call, I think that'd be a great takeaway.
Sure.
So that's just important for folks to, and the call would be what? Just to engage and answer questions, like what?
Yep.
Just tell the group a little bit about that.
Yeah, absolutely. So that's going to bring you to our calendar. You would be meeting with Amy, myself, one of our colleagues, but we'll run through the fund with you, give an overview of, our assets, what, how much is in each, what we do, what our outlook is, kind of answer all those general questions. What happens at the end of your investment? How do you get started? What kind of paperwork, what the accreditation process is like? And then also what to expect while you're invested in the fund, you know, the tax forms, where to find your quarterly statements, you know, things of that nature. So a very general, you know, we'll give you the overview, but we also leave plenty of time at the end, you know, for you to ask questions, come to us with questions. We like for our investors to, like I said, read the PPMs, read through our audit, and come back and schedule another phone call. We're not the hard sell type of people. We want you to, you know, again, feel comfortable,
Yeah.
you know, with who you're investing with, and making sure it's the right move for you as an investor. So absolutely a very free and open call. You can feel free to
Yeah, no,
take it in any
and they can
direction.
call and ask us anything. So even if, you know, they're not accredited yet, right? But they want to schedule a call and they want to ask questions. That's what our team is here for, you
Yep.
know. Ultimately, even a non-accredited investor, if they have a good experience and we can answer their questions and help them grow to become accredited, they're going to come back to us when they
Right.
are accredited, because they're going to be like, hey, they gave us great insight.
Yep.
Yeah.
So,
I'd
Nope.
love to hear in the chat box, you know, a couple of things. Number one, what is your biggest takeaway? That would be great. So you hold yourself accountable to, okay, this is my one thing that I'm taking away from this call. Hopefully you're taking a few things. And then the second thing is what action you're going to take. So one is, what have you learned? One thing you've learned, and one thing you're going to do. Maybe this has sparked you to do a little more research in one or the other, or something in your world. Schedule a call with these, you know, with these wonderful women. But what is your action? Because in anything we consume, our big belief is that an action should be taken, even if it's a really small action. It doesn't matter how big it is. It's about taking action, because then you're building confidence in yourself and you're moving the needle on your investing journey. Whether or not you end up doing one thing or the other, that's important, but that's actually not the point, right? It's like taking action. So I'd love to see in the chat one takeaway and one action step that you're going to take. And I love what you said about asking about whether they've defaulted, and when things haven't going according to plan, what have they done to mitigate that? That's a really great question, because you cannot take any operator and every single project they've done has been, you know, rainbows and beautifulness. There's
Exactly.
always
And
things that go wrong.
that doesn't exist.
That
ever.
doesn't exist. And that's actually not important. What you want to know is, how do they mitigate that? And how do they communicate to their investors? How do they make them whole? Or what do they do in the times that are tough? That matters versus anything else. So,
Absolutely. You know,
Christina, looking to my portfolio to see what capital I may have to deploy. Absolutely, Ginny. Really understanding the difference between equity and debt investing. I'm going to research several different funds, see what kind of requirements they have, plus their commitments. Thank you, ladies. Yeah, you know, and Christina, I know you're working through a lot of different things. I know you're not going to share your personal situation, but you know, talking to these folks too will be a great step towards that, to start putting in your plan, right? Your long-term plan, which I know about. Very cool. Awesome. Anything else from the two of you before we end?
No, I mean, you know,
thank
you for the opportunity.
Yeah, thank you for having us. And we're looking forward to June to
Yes.
being at the investor
Yes.
conference. I'm looking forward to doing, you know, my little breakout panel.
Yes.
Last year when we were there, and it still rings true for this year. It was one of the best conferences I had ever attended, and I have been to a lot of conferences. So, you know,
Well, and thank you, by the way. I'll talk offline with you, but had a call with somebody who actually heard about us through you guys. So thank you for that.
Yeah.
I will send you're on my list to thank and send a note to. So, but I actually put the link in there for those who are joining us. We cannot wait to see you June 1st to 3rd, and come with your questions. And these two women and their team are such high integrity in education. And you want to go with companies always, and getting advice from companies that have been there, done that. So excited about June. If you don't have your ticket, come join us. We are really excited in the last few months as we're, you know, working towards a great conference, our 4th one. So thank you everyone for being on. Do something with what you learned, move the needle, connect with these wonderful women, and we'll see you soon on our next webinar. All right.
Thank you.
Thank you, everyone. Have a great day.
You too.